computer. All right. Well, good morning, everyone. I'm Timothy Yee with Green Retirement. We are having a talk today on student loans with the folks from Summer. But since we are recording this, I am required to repeat a disclosure. Again, I'm Timothy Yee with Green Retirement, a registered principal offering security and advisory services through Independent Financial Group LLC, IFG of San Diego, a registered broker-dealer and investment advisor, member FINRA, SIPC. Meet Summer or Summer, Green Retirement, and IFG are unaffiliated entities. We won't be talking about investments in this particular program. But still, I am required to say past performance is no guarantee of future results. Michelle, it's good to have you here. And when I first heard about a B corporation doing student loan programs, boy, was I happy to see that. And folks, my excitement really got started with Secure 2.0. And welcome, Rory. Good to have you. In Secure 2.0, they had a little tidbit about student loan forgiveness. And let's see, Rose, you might need to mute. So I'll mute that. That way we don't get the Jimi Hendrix effect. Secure 2.0 said that an employee could take part of their salary and pay off student loans. So say it's 4% of each paycheck. And let's say the employer had a match of 4%. Well, if you're paying off your student loans and not contributing to the 401k, you won't actually get the match. But Secure 2.0 said, yes, you can. You can pay your student loans and get your employer match. And that got me excited. One thing I will say about Congress is they never bother to explain how to do things. They come up with these great ideas and then they leave the devil in the details to everyone else. And that's where groups like Summer have come in. They're a fellow B corporation, and I'm really happy to have Michelle Tran from Summer to not only talk about the program, and Michelle, thankfully, you have a background in record keeping, so you can fill us in on that and how this all works. I will say, though, folks, ADP has picked this up. Now, Cindy, Lena, I know you guys are with RPC, as is Paul. Rory, the platform that Tiger uses is July Services. The Harmonia plan is with RPC. And then we also had somebody from RPG using the RPG platform. As this gains more traction, I think we're going to see wider adoption of it. Again, ADP was one of the first to say we're all in. But naturally, we're not focused just on the match. As I was talking more with Summer, they explained to me that, and Michelle, you'll have to expound on this, that up to 70% of the money for student loan forgiveness is not being claimed or student loan programs. And first I was overwhelmed. Then I saw the business opportunity. And of course, then my mind naturally jumps to, well, if there's a business, there's a fee. And thankfully, we have B Corporation. Michelle is going to take it away. Michelle, I've enabled screen share. If you want to
Great.
bring up your presentation, give us the background on the landscape and not only where Summer fits in, but SoFi, Thrive, Vault, all these other competitors. What makes you as a B corporation stand out? The floor is
Yes.
yours.
Thank you. So nice to meet everybody. My name is Michelle Tran. I lead commercial, which is sales and marketing for Summer. And as Timothy said, we are B Corp corporation. B corporation really focused on enabling student loan benefits for employees through employers. My background is in retirement, so I spent number of years at Vestwell. I don't know if anyone here uses Vestwell, digital retirement platform. So I know the RPAGs, RPAGs, the ROCs, the July services, Empowers, everyone very well. And so this is actually near and dear to my heart because what I am focused on for Summer is really how do we work very closely with the record keepers, ADP, and others. And just as a very quick headline, we can work with any record keeper. We can work with any payroll company. And so to take a step back, as Timothy was saying, Secure 2.0 really is a game changer right across the board for a number of different reasons, including student loan repayment and the ability to match that into your 401k. And you think about it, right? As me, a new graduate, I don't have to make a choice now between do I just put money towards my debt or do I save for my future, right? The impact that it has for an employee really allows that employee now to set that foundation for a financial future. There's a reason why we're all on the 401k side. We know there's a big impact and you start saving early, compounding, all those good things. And so Cure 2.0 really helps employers offer that to their employees. And I'll talk a little bit about the how too, because there's a lot of questions that Timothy said. Great, that's Cure Act 2.0, but they didn't really go into the how. So let me start. What I'll do today is really kind of start from a high level in terms of what's going on in the student loan space, why this should be important to plan sponsors. And then we'll talk through summer itself, what are the various different ways to engage with summer and why? Why do companies actually use summer and why do they offer student loans? And then I'll go more specifically into Secure 2.0 and the implementation of that. Does that work for everyone? And please feel free to jump in with any questions at any point as well. I'm here to be a resource for you and answer questions. Um, Timothy, his first question that he asked was, summer, why summer? And how are you different from some of the other players in this space? One of the things in terms of why summer is that we have saved we have saved more for individuals than any other student loan platform out there. And the reason being is that because we have worked and created the most wonderful, efficient technology to help assist employees and individuals through that programming and to find the ways to save additional debt. We work really closely in partnership with a lot of groups. And so there's a number of different ways that we really focus, especially as a B Corp, on how we help individuals. And so we have saved over $1.75 billion by, these are folks that have applied for government programs, getting money from their employers or through Secure 2.0, and really to tackle one of the biggest debt issues that we experience in the world today. Overall, in the US, there's a $1.7 trillion of student loan debt, and it's huge. I don't, for folks who are on the phone who've had student loan debt, or you have children who are about to go to college, you might be taking loans out for them, or you're just trying to figure out, okay, how do I help my kids pay for college, or how are they going to pay for college, right? Debt is a big issue. We work with over 2,000 employers in all different industries. We do a lot in the medical space, so hospitals, we work with teachers, we work with financial services firms, Assurian, as Timothy mentioned, ADP and Fidelity. So we work really across the board. And really, when we think about why people use summer, not only do they want to help their employees, but from a business perspective as well, they really want to ensure that they have a program out there that works on retention and recruiting for them. It's a competitive market, especially in the medical space that we're talking to a lot of folks out there, there's turnover. How do you make sure you have something out there that helps you stand above the rest? And student loan has a big impact of that. And so we are led by a number of founders. So you had mentioned SoFi. We actually have our president is the former co-founder of SoFi. He has a good relationship with our CEO and heard what we were doing and wanted to join more formally. So we're really excited to have Dan McElhenney, who's been here for a couple of years. Will Seeley is our CEO and founder, and he came from the student loan space. He was in Washington writing student loan regulation and saw a problem. And this goes back to, and Timothy, I'll go into it. No one, like, it's very few number of those are accessing free government money. And this is money that the government is offering to help pay down student loans that people just don't know about or they struggle to apply for. So we have a really great bench of amazing folks in all different areas of that space. As you all know, college is expensive. Vanderbilt, I believe, was last year the first college to hit $100,000 a year. And I was just on a call with someone for Vanderbilt, and he said, luckily, he went there so early that he didn't, that wasn't the cost. But now, if he sent his son, it's $100,000. But I have 4 kids, and just the idea of like, okay, how much it's going to cost, just, oh, it's crazy. And so there's two elements of it. It is how do we help families save for college? What are the guidance there? And then paying for college. So those that actually hold the student loans within the household, your spouse, your uncle, whoever it is. How are you actually paying down that debt, right? Most people graduate with debt. I think right now over 70% of Gen Z is coming out of college holding some type of debt. So really when we think about summer, and it really does equate to This is money, this is by accessing all these programs, it's essentially a raise that you can provide to your employee by accessing all these programs, by the contributions. And this is money where like, people are always asking you, hey, pay us more, pay us more. This is a way they can actually get more money into their pockets because they're reducing their debt amount. When we work with employers, the first question I typically get from employers is, well, I don't know how many people out of my employees hold student loan. And that's actually, part of those who can actually benefit from the student loan program. It includes not only just those who are holding student loans, but there are also those that are holding family member student loan. I was just at a conference on HR tech. This woman walks up and she's like, can I use this? I actually have my daughter's student loan and I'm working on paying it down. This is also a household benefit. So we offer summer to members of household. So for example, if your spouse is a doctor and they need to figure out how to pay down their student loan or a vet or whatever they do, they're able to use this platform. We also have college cost savings tools. So that part is really available to any caregiver, regardless, any parent, grandparent, regardless if they hold student loan or debt, student loan or not, really helping them understand what is that college cost. And then we also know this, right? Women hold 2 times as much as debt, student loan debt, and also Black borrowers hold more debt than white counterparts. And so overall, if you look at the DEI, BI benefits groups, the parents, the upskillers, and then the student loan borrowers, it really does make this really eligible up to 90% of an employee base at an employer. As Timothy mentioned, there are a lot of government programs that people are not taking advantage of. And these are just some of them. And some of the reason is when they don't know what they are, right? It's a hard world to navigate, and so I don't know what they are. And sorry, I'm seeing their chat right now, so I'll help answer that. Yes, there you go, Timothy. Yep, exactly. Only 8,000 when you went there. That was a steal. That's like I don't know what
Go
it doesn't
Bears.
exist anywhere else. Um,
Michelle, can I just ask a question on the
yes,
previous
please.
slide? I'm sorry I raised my hand, but was maybe a little bit late. Yeah, on the previous slide, you said that Summer is also offering savings for college and not just paying for college. So it seems to me like you're addressing both of those aspects of going to college, saving for it and paying for it. And so how is saving for it? Because there are 529 plans. So is Summer also into 529s then?
Yeah, so
And
we
I
help
mean, you can
parents.
just a short thing I just wanted to clarify that.
Yeah, absolutely. There, what we're doing is helping parents understand how to save for it, right? We all know there's 529 plans out there, but do your employees know and do they know which one, right? 529 plans can be a bit complicated based on what state you're in, tax advantage versus not. California, it's not. New York, it is. So we help identify 529 programs, other vehicles for parents to use in order to start saving. We also
Oh,
identify,
okay.
yeah, and we also
So
identify
it's not that Summer itself offers
Oh,
529
no. We don't have a
plans.
529 ourselves.
Yeah.
Um,
Okay.
Future state, what we're also going to do is the ability to enroll directly into 529 through summer. That's not today, but that's future state. We know this is a big question. Look, my kids are young now, but if I don't start doing something now, I'm not going to be able to afford it later. And I have too many kids for the state of California. I have 4. Um, so government programs. So these, the government programs and accessing these government programs, and people don't do it because they don't know what they are, and it's a pain to apply for them. So you think about like government forms, right? Y'all aware of any government form. It's very difficult, very cumbersome. And there is a very high rate of rejection when it comes to filling out these forms. And so what our platform does is that we help fill it out for them, and then we do a review and submit it directly. And so again, we do serve a very diverse population. I think one thing people don't really tend to see is like the average age. People make an assumption that the average age of a user is about 25, 26 that comes out of college. It's actually 40 because those that have maybe multiple degrees, or it just takes a long time to also pay down the debt that people hold. And so we do have a big, kind of a higher range of users, also for those caregivers and parents who are using the platform. And this is real money. This is really significant money. So the examples that we have here, the 30,000, the 29,000 of forgiveness, we work both with nonprofits, we work with both private companies. We support the American Federation of Teachers, and every Friday we have a forgiveness story, which is one of my favorites. And a couple of Fridays ago, we highlighted a teacher, and teachers don't make a lot of money. She was able to get $230,000 forgiven through using the summer platform and working with the summer experts. And that's a lot of money. That's not only just for anybody, but specifically for a teacher who doesn't make a ton. And her comment was, I'm not, I worried about defaulting on my mortgage, and I don't have to worry about that anymore. And now I can take my kids on vacation. So that's one of the reasons why I joined Summer, because passionately I wanted to have an impact in the world. And that is the impact of offering this to your employees.
So, Michelle, I have another question then
Yeah, please.
in terms of the teacher. So does that mean then that you work with CalPERS and other state-run retirement plan systems in order for the teachers to take advantage of the summer offering?
We currently, what we help with teachers very specifically, nonprofits, government agencies, is the public service loan forgiveness. And then we help offer a guidance when it comes to some of the other programs. So really right now, it's the federal programs that we're focused on and helping them through that forgiveness journey. And as you know, like in the public sector, it takes 10 years. So you have to be enrolled in an income-driven repayment program every year in order to continue to work towards that public service loan forgiveness at year 10 or at the end of year 10. And you have to recertify every year. So that's what our platform helps to do, is we help to recertify every single year. We help you enroll in the income-driven repayment program. We help you recertify every year. And then at the end of the 10 years, we help with the public service loan forgiveness.
I guess I'm just a little bit unclear, because I thought that summer only works through employer-driven plans, but with the teachers, their employers would be the state or the school
Yeah.
district, and so does that mean that the teacher can just go direct to summer, as opposed to them having their school district be a customer of summer? I guess
So
is more my
yeah, for
question.
the teachers, that one is unique in terms of we do work through the American Federation of Teachers. So if you're a member of the American Federation of Teachers, then you have access to summer. So for that structure, we didn't go through like each school system. We are talking to actually a couple of different school systems, but that one specifically is the American Federation of Teachers.
So does that mean then, Michelle, that if summer can work with a federation as opposed to an employer where the employee has a W-2 relationship, that summer can offer it to like coalitions or
Yeah.
okay,
Yeah.
well that's
We're happy.
yeah,
Well,
okay.
however we want to structure it, like we work with and sorry, Paul, I'll get to your question too. We will, like, for example, we work with an organization called VITA, and they work with a number of nonprofits. The nonprofits that they work with are smaller nonprofits, so they're like 5 employees, 10 employees, for example. But we work directly with VITA, and then through VITA they offer it out to all of their nonprofits. And so it's really just dependent on like how do we ensure that we get this product out to the right folks? And so we're definitely open. It doesn't just have to be the employer.
Okay, well, that's
Yeah.
really good, because I have some ideas that
Yeah.
maybe offline I can discuss with you.
That sounds great. All right, Paul, you're up.
Thank you. I'm sorry if I missed this, but how do the loans get forgiven? Does somebody apply and say they have a hardship, or who forgives it? Like, how does
Yep.
that work?
So there's 2 different ways to think about forgiveness and so there's one is in the public sector or nonprofits, like as I mentioned, the teachers, you can get the entirety of your loan forgiven in 10 years. What you have to do though is, in order to do that, I'll just say as an example, as a teacher, you have to enroll in an income-driven repayment program. Those are the government programs that help reduce the debt. So what it does first is it takes one step. The first step is it reduces your current debt, sometimes by half, sometimes by a quarter, whatever your situation is. So that's a first step. And you're required every year to reapply and recertify for these programs. You have to do that in order to set yourself up for the full forgiveness when it comes to the end of 10 years. And so that's what our platform helps to do, is to keep you on track, that you're not missing any of these recertifications, that you're to one, taking advantage of all the IDR programs, and then that you're also on track for that public service loan forgiveness. So we have like pizza tracker, right? That helps to see, okay, well, where are you? Have you done this? Have you done this? And then we also, on the back end, have certified loan experts. So these are people who have been certified in the student loan space. They're the ones I call anytime I see a headline. I'm like, tell me what this means. They're available to all employees to pick up the phone, to email, to text, and say, okay, help me understand the situation. What do I need to do? And so we do back end what I call high tech, high touch. And so that's the full forgiveness. Now, if you're at a private entity, you don't get access to full forgiveness, right? Like I work for a private entity, I can't get all my loans forgiven. But what I can do is still access these income-driven repayment programs. I still can get my monthly reduction in debt. In some cases, the average debt amount, our average in terms of reduction is over $250 a month, and how much we've reduced debt amounts.
Right. And who's funding that? These are federal programs?
These are federal programs. And so
Okay.
those income-driven repayment programs are federal programs.
And how long have they been in existence?
Years, decades.
Okay.
And there's new ones that come up, and there's headlines about some.
Right.
You may have seen headlines recently. One that Biden introduced is now in the Supreme Court. So that
Uh-huh.
one specifically is a pause, but there are many others.
Okay. And then this will be my last question on this
Yeah,
topic.
no, please.
Sometimes federal programs get canceled or sunset, or so what's the risk of somebody luckily having a lower payment for 7, 8, 9 years and then not getting the forgiveness because of a change in the program or the administration?
There's a low risk, because if there's like a change in what we'll do is we're able to see who's in every single program. So for example, let's
Mhm.
say Save just gets completely canceled. We'll
Mhm.
know who everybody is enrolled in Save currently. And then what we'll do is a proactive reach out to everybody and say, okay, let's get you on track in an income-driven repayment program. And it could be another income-driven repayment program to keep you right. So I do think it's a lower risk. We personally think like this is the policy piece, right? Like we do kind of have to wait to see what happens over the next month. There may be something new, but what we have seen, is there is support for programs like this generally. And there's a lot of those programs out there. So it's not all going to get canceled completely. And that's one piece of summer. There are a couple other kind of ways to engage with summer as well, and that's the loan piece, the federal loan piece. Is
All right, thank you.
that
It's a lot of
helpful?
complexity.
It's a lot of,
Yeah.
and our job, like I call us the TurboTax of student loans, because our job is really just to reduce that complexity. So it is really simple for individuals to apply for these. And what that really means, like in pure numbers, it takes 8 minutes for someone to sit on their phone, apply for these programs, log in, do all the things, and then submit. Because what we've used is technology to fill out the forms, and then we have someone on the back end and we submit it on behalf of people. Um, Whereas like it's similar vein of like you were to download your tax forms from the IRS, fill them out yourselves and submit them to the IRS, that would take you forever. And you probably have 1,000 questions, even if you're a CPA. And that's the same with student loan enrollment, debt reduction enrollment. What we do is we do end-to-end enrollment. So we recommend a program, we fill out the forms for you, and then we submit it. So we take that. And the reason why we do that too is that there is over a 90% rate of rejection when it comes to people filling out the forms and submitting it themselves. And it's not because they're ineligible. It's maybe they put the date wrong, they put a slash instead of a dash, whatever it is. And then you get this email back that says this didn't work for you. It's not. And they don't know why. They didn't tell you that it was this dash in this box, right? And so what we do is that we know these programs so well. We've built technology to fill out each of these forms very specifically, and then we give it a once over with the student loan experts because they know the forms super well. I think I jumped ahead of my presentation, but that's kind of the book of some of what we do. I did want to highlight for you just from a timing perspective, with all the regulation in place. A year ago, they said you have to start paying your student loans, and they gave everyone basically a year to start paying their student loans. Only 50% of employees are now paying student loans. So there still is a number 50% who are not. The thing that you need to know too is that come October 1st is when the government's going to start penalizing employees for that. They're going to start like credit scores, wage garnishments, all those kind of things will start happening October 1st. So that is coming. So something to be aware of. So I did jump ahead. So I just wanted to give you a sense of who is Summer and what do we do? And I'm going to put it in 3 different buckets. So the first bucket is Summer Save. What we've been talking about bulk of this time is in terms of the government programs, the college cost planning tools. And we really see an average of, over 250, 278 a month, and then 40,000 total savings. And then again, access to our certified student loan experts. So that's the blue bucket. And the green bucket is what we call summer boost. And this is employers boosting an employee. That's why we call it boost. And what this means is that you have a budget and you're helping to pay down your employees' student loans. That's one piece. And then the other piece is if you have education assistance. And this is tax-free programs under Section 127. And so a lot of firms are using this as a retention and recruiting tool. It says, and you can set it up in many different ways, but what we typically see is, look, you've been here for 90 days, now you're eligible, and we're going to start paying $100 into your student loan, directly into your student loan. And so that's further reducing. And then if you're here for 2 years, we're going to increase that to 150. If you're here for 3 years, that's going to increase to 200, however you want to set it up. So that's really used pretty heavily in terms of making sure that there's good retention and also to recruit, new employees to come in. Most programs now, or most firms now offer also, if you want to upskill, if you want to continue education, $5,250, which are tax-free programs under Section 127. And we have a platform that will help you administer that. These are programs where, okay, manager signs off, you have to upload a receipt. Oh, did you finish the course? Type of thing. And so we help administer that. And then as we were talking about before, Summer Secure, which is the Secure 2.0 platform. So Secure 2.0, the provision of allowing plan sponsors to match student loan payment into the 401k. This is where we have a platform, and we do have a partnership with ADP and can work with any employee or any record keeper where we verify that student loan payment. So a little bit on the implementation and what has come out from the government. About a month ago now, the Treasury and IRS came out with some interim implementation comments. It's not finalized yet. So they're still waiting for comments back from a lot of folks. But what they did say is, look, you can either offer self-certification or you can offer third-party verification. What we're seeing, though, is the trend of the third-party verification because, hey, Michelle Tran, great, you're a great employee. You're saying you pay $500 into your student loan. Are you really doing that? Right? Or is it, we want some type of verification there. And so we have a full platform that enables the third-party verification. So I'll pause there. Any questions just on kind of the offering and how it shakes out?
Yes, Michelle. So in terms of companies then, because we're thinking about our clients, our 401k clients, is there like a minimum number of participants for a company that do you have that type of a thing, or can any company just sign on to Summer?
No,
and then hopefully you'll talk about the costs as well. Okay,
yes, I was just about
thanks.
to talk to the cost. It's a really great question. And so when you look at these 3 programs, our core platform is Summer Save, which is the blue. And then typically what we do is that, Summer Save is used with Summer Secure, or Summer Save is used with Summer Boost, or you use all 3. So you can make a choice there. So you don't have to come to the table and say, I want all 3, right? What we don't say that there's a typical minimum. We do have of employees. We charge on a per employee per month basis. So we look at all employees because of the extensiveness of our platform, right? The college cost planning, the savings. We just got off the phone with a group that does physical training. And so they're like, well, originally we want to offer this out to just our certified clinicians, but we think actually it's beneficial to everybody because it really is at that 70 to 90%, as I talked about earlier. So we do have a minimum fee. Our minimum fee is $25,000 a year annually for this platform. And that includes a couple different parts of these. And it could be, Summer Save with Summer Secure, Summer Save with Summer Boost. But we also just look, in full transparency, we look at every situation very specifically to say, hey, does this cost make sense? Is there a way for us to aggregate all the employers that you work with through green retirement and ability to offer and move that down a bit too? And so there's a lot of different ways that we can look at that cost. But if you were to say someone calls me up off the street, that's what I would, our rack rate.
Yeah, and the conversation, folks, since we're diving into fees, and I have not explored this with Summer in any great detail, but they are looking at spreading that 25,000 over 4 employers. So then it's down to 6,250. Also, it does require that we talk to the record keeper. So retirement plan consultants for many of you, July services for some of you. And for those who will be listening to the recordings, we have plans with RPG, Paychecks, and employee fiduciary. So each one, we would need to make sure the integrations are set up and how many employers do we have on each platform, and is there enough interest from each of those employers? So it is a fairly complex thing. Really, what I was hoping to do is put this program out, see what interest there is, both from the live session and then from the recording, and sort of start the conversation with the record keepers. ADP is the first one to take the plunge, and I didn't know Fidelity had. But for a large enough employee base and spread over 4 employers, it becomes, I'd say, perhaps a worthwhile program. And since compliance will review this, I don't work for Summer, folks. They're not paying me a referral fee.
Yeah, and I will say we can work with any record keeper, and it actually is not that complex. Really, the way to think about it is if you're doing the retirement match piece, it's part of the contribution. And so really it's a conversation really typically with payroll, honestly, is where it starts, to making sure that that field is captured accurately. It's just simple data files. I'm probably simplifying it. My product team is probably like, you're way simplifying it, but it's data files that go back and forth, and it becomes part of contribution, right? So they're putting in, if you're matching contribution, I'm putting $100 into my student loan. You're going to match it, my retirement match, and put $100 into 401k. That adds up into the total max contribution amount, right? So that's still in that contribution world. And so it really is that simplistic. The reason why we have a deeper integration with ADP is because they wanted to offer the core of the program, Summer Save, out to all their ADP retirement employees, and then Summer Secure, excuse me, which is the student loan verification piece for the 401k, is an additional conversation that they have with their plan sponsors. And so there's many different ways that we can create the right partnership, create the right mechanism to make it very valuable for you. And then just so you know, on the back end, that's where we step in. So we have a dedicated partner success person that works with every single employer to really understand what's important to you when it comes to engagement, comes to onboarding. This is, you really do have support at every level, from expert loan advisors for your employees. And then as an employer, you get a partner success manager. And what they do is they help you launch very easily summer. And so this is just an example of a launch that we've done with Hurley Medical Center. And we launched them in June. So we create all the materials. We decide, do you want to send it? Do you want us to send it? However you want to do it. We host webinars, curated, dedicated webinars based on what your situation is for your employees. We get the word out to the community, so we can help with blog posting. As you think about the competitive nature of some firms too, in some industries, making sure that people see that you have this amazing benefit, so they'll go and they'll stay with you as an employee. And this is a little bit since last month, so I think some of these numbers have changed. But what we've seen with Hurley Medical is that we have reported an average loan balance of 58,000, average salary around 94, and we have now projected that we'll be saving their employees $1.8 million so far. And that's pretty significant. And that's a $244 savings, average savings across their employees. That's $244 back into their pocket that they're not spending on debt. So effectively, they're getting somewhat of a little bit of a pay bump by doing this. So we're really excited to partner with groups, and that's what the team does. We have these planning calls and college calls, so we really want to be supportive of employees and employers, and that is a big part of what we do.
That's a good point, Michelle. And the folks, the thing that I'd point, really going back to that First Friday forgiveness story. I like that, Michelle. It's the peace of mind. Employees being able to not worry about this part and hopefully then be able to focus more on work and being productive because they don't have this financial drag. Back
Yeah,
to you,
I totally
Michelle.
agree. Yeah, it not only more productive, but when you think about all the things that surround debt and financial wellness, it has a big impact on your your mental health, has a big impact, and that has a big impact on your physical health, right? So it's all really associated. And financial stress is one of the biggest factors in just stress overall. And so how can you help your employees take away some of that stress, right? Not only for them to be more productive, but really for them just to be healthier across the board. And so, we're really excited. I joined Summer because I was really excited about the impact that we could have. How can really employers help? I've been in the student or in the retirement space for many years. So, that was also a reason why I joined the retirement space. Like 401ks are really a big benefit to employees, and I don't think enough employees are utilizing it. And we know that, right? And so this also will help drive participation. A lot of the record keepers are behind it. We just hosted through the Plan Sponsor Council of America an event in Washington, D.C. a couple weeks ago where we got all the record keepers, the Empowers, the RPAGs, the censuses, the SSNCs, you name them, in a room together. There was about 40 of us with Treasury and IRS to talk about Secure 2.0 and talk about how we really making sure that it gets this student loan piece of Secure 2.0 is really optimized. Because we want to see it adopted because it has a really huge impact to people's financial future. Going back to the comment I made very early on in terms of women and people of color are disproportionately affected by student loans. They just hold more student loan. This really allows these group of folks to save more for the future, right? And as if any of you know, the sooner you put money into your 401k, the better off you're going to be. The compounding starts. I don't have to tell you this. You all know that story. So just really want to say, thank you, Timothy, for having us on and really excited about opportunities to work together.
I appreciate that, Michelle, and definitely open it up to any questions you folks have. But again, this was an initial call. I learned about this earlier this year, and then actually met the folks from Summer at the 401k annual summit that was held in April. Wow, April in Nashville. And that's what led to this conversation. So right now, I'm just trying to get ideas as to how many employers may be interested in this. Does this make sense? And then the heavier lift is the integration and making sure everything pencils out correctly. But questions, folks?
I have a question. So it sounds like you're targeting larger enterprises or larger networks with that minimum. But what's the actual pricing? Is it per person? And if so, what is it per person per month?
Yeah, it usually works out to around about $10 to $12 per year per person. So around like 1 to 5, depending on like what you're going to use, um, and how many employees. And yeah, so we are targeting, I would say like mid-market and above typically. But I will say because of, kind of economies of scale, is there something that we can work with Green Retirement to help reduce that amount? I honestly, and apologies, I don't know, like, how many employees, what's the average number of employees per plan sponsor. And so that's definitely something that we can explore. And then again, like the case study that I gave you, I said earlier in terms of like Vita. Vita is a platform. They have all these not I think they have like 40 nonprofits that they help support. And they're all
Right,
smaller nonprofits. And
right,
none of those nonprofits could probably afford Summer on their own, but they really
right,
want to offer it out to theirs. So that's where we can get creative.
right.
Well,
Yeah, because I think the dollar per month per employee, that's easy to say yes to. Like, would I spend $12 a year per employee? Yeah, of
Yeah.
course. So, but not all of them have student loans.
correct.
Fortunately, I paid mine off early. But some of them have master's degrees, some of them have PhDs. So, yeah, so if there's not trying to negotiate or anything, but if there's some approach that accommodates for who has loans or how much they are, or even how much the
Mhm.
savings are, that helps to translate into the value um, for groups of uh, less than mid-market companies that
Yeah.
will all get bigger over time, and so your revenue grow over time. It's unclear what the work is, and so I understand like insurance, like if you charge everybody a low rate, then you can pay for the whole system. So, but it sounds like there's an opportunity possibly for like a second system, which is how do we add value to more people? Once they get into it, they're going to refer it. So there's a high level of a referral value.
Yeah.
So this minimum could potentially be lower.
Yeah,
I would
and something
agree
to
with.
think about too, is so we do definitely we do offer a PEPM structure. The thing to think about too is who's using the platform.
Mhm.
And that goes back to caregivers. That goes back to household. This is a household benefit, right? So this
Mhm.
is, and we don't, when we look at pricing, we look at just the employees. We don't look at we don't calculate it based on like making an assumption that there's 4 people in your household. So
Right.
it's just on the employee number. But effectively, many households do use it. Examples of spouse that's a doctor, right? Like they have access to the platform. And so that's one way just to, as you frame it and think about, okay, what does this cost? And I definitely think like, and that's something that maybe I can work with Timothy on is just getting a better understanding of, all the groups that are interested here. Is there a way for us just to make sure that like one, it's right size? And I totally get it, right? Like if you're a company of like 20 employees, that's an astronomical cost for you. That doesn't
Mhm.
quite make sense. Um, and that's where just for, what would be helpful for me is just to get a better understanding of like, what is the makeup? And then I can come back to the table to say, okay, let's structure it this way and just make it really easy, kind of a little bit more affordable for everybody.
Yeah, my thinking, Michelle, and obviously I'll yield the floor to Rose, but as we start thinking about associations, I almost thought of the Green Retirement Association, and here's yet another added benefit of working with us. And Rose, of course, would lead that discussion when she's not busy running for Congress, which
Mhm.
is occupying her time. But Rose, Michelle is over in the Crocker Heights area of Oakland, so we used to be
Oh, Rose,
neighbors when
am
we were
I
up in
in your
Skyland.
voting group? I will look you up.
Yeah,
Mhm.
yes, please. I need all the support and help that I can get. Donations are welcome. You don't have to be from District 1 to donate. So thank you to Paul, who's one of my donors.
Mhm.
So I was going to, my point that I was going to raise is kind of like what Timothy had mentioned when you said that you're working with the Teachers Federation. It's I'm wondering whether indeed it can be something that we can, as a collective of all of our clients, we can work with Summer because, yes, we have clients who are single solopreneurs. At the same time, we have clients who have more 100 plus employees, and so together that group could conceivably, as a collective, work with Summer. The question that I have is that we have for-profit as well as non-profit clients. So is that going to be a barrier? Do we have to create a different one for-profit companies and a different one for non-profits? Because then the challenge of that is that would lower the pool because that it would be 2 pools as opposed to just one collective.
No, we can look at it together as one collective. The value proposition for nonprofits, there's an additional value proposition because of the public service loan forgiveness, where the 10 years and you get everything forgiven. And that just comes down to like we just need to think through how do we engage those nonprofits versus for profits because the messaging will be slightly different. But I think overall, from a higher level relationship, that it is that's not different. We would just take you all together and figure out, okay, how does that, like, what does that cost then?
Michelle, can you unpack a little more on the 10-year loan forgiveness nonprofit? Is it specific organizations? One of our clients worked for 10 years in one of the prisons as a psychiatrist and got 10 years worth of USC paid off.
Yeah,
Is it certain organizations? Is it any nonprofit? Fill me in on that.
not any nonprofit, any public service public service entity. That's where the teachers come into play, governments. So we work a lot with cities. So a lot of cities, municipalities. We're about to launch with the city of New York for over 300,000 of their employees. And so it really is, it's open in terms of I would say public service and nonprofit.
Now, these programs have been around for decades, and I must say, uh, the Secure 2.0 really was the first time I started hearing about government programs. Are they just not widely advertised? Why has there been a lack of traction over decades?
Yeah, I think they're not widely advertised. So we do work with a lot of nonprofits who are like really looking for ways to retain their employees.
Mm,
We worked with a nonprofit in Palo Alto, and they're like, we're struggling to retain our employees because they're just going to like, all the tech startups that are surrounding us. And
mm,
so, what are some good programs that we can offer to help make that comp a little bit better or make that benefits a little bit better? Um, they're just not widely advertised, and it takes it's up to the HR teams too of these groups, like the hospitals, the teachers unions and stuff, to really talk about it so these teachers
mm,
and everyone else knows about it. And what we really do is we just make it easy for them to do it. A lot of comments I get when I talk to kind of folks are like, oh my gosh, my wife just went through the process and we finally got forgiven, but it took us, we had to fill out all this paperwork and I had to chase the HR team, and they're like, it was just such a painful experience. So our whole goal is just taking the pain out of it, the friction out of it. Like, how do we just make this as easy as possible to enroll? Because as you
mm,
know, right, like even if it's something like out there, when it becomes hard to do, people tend not to do it. And that's the case for 401ks too, right? If you
mm,
make it hard to enroll in a 401k or hard to invest in a 401k, people are just not going to do it,
mm,
right? Because they just can't see it. They don't see the benefit. We all know, the benefits of it. But so our goal really is just to make it as easy as possible, and make it widely known too. We talk about it
mm,
all the time.
mm,
So just a question, drilling down into the logistics, and I know there we'll be going through more in detail about this, but so let's say we do organize. There's enough interest amongst our clients. We do have like 100 plus plans, Michelle, and so there's enough interest, and we feel that we can move forward. Would each client, for example, who wants to have this program in as their benefit offering, do they have to enroll all of the participants, all of the employees, or is it again voluntary? Because then, is it I guess it's a question of opt in or opt out, or is it all or nothing?
It's not all or nothing. And it also, there's a lot of dependencies to get to that, right? To get to your answer. There's a lot of different answers too. So I apologize for that. I'm not answering your question very specifically, but it really depends on how we structure kind of this broader relationship, and what's the interest, and the makeup of each of these companies. And so, for example, if one firm was, let's just say Paul's, for example, Paul's firm wants to offer student loan contribution. He may say, great, I only want to offer student loan contribution to this segment of employees. And we see
mm,
that pretty often. So that in that case could be like, yes, that's a carved out section of employees. Um, Cindy, on your side, you may be like, nope, this is great for everybody. I want everyone to have access to it because it's a big benefit. I want to make sure, it's splashed out there. And so that is then just sent out to everybody, not a select group. So it really depends on like what is the company's goal, and also kind of like how you think about the three kind of buckets that I talked about and what you're interested in really offering out. I would say the simplest thing is the summer save, which is the income driven repayments, the college cost planning, the access to the loans, starting there and then pushing that out to everybody, because really it is, kind of available use to a lot of folks. And even if it's your employee who maybe doesn't have a kid or it doesn't have student loans, there's typically someone that they know who could use it right within their household. There's a high likelihood. Um, and so I think it really just depends on how we structure it. But it's not like 401k auto enroll where you have to like get everybody in. I hope
So
that's
then I
helpful.
guess, yeah, it is, Michelle. I think then, Paul, to your point, where it's sort of a cost analysis. How many employees do we have? Of that population, how many are interested? And then as we figure out the pricing, which again, given the size of our organizations and our networks, I'm sure we can figure that out. Then it becomes to some extent, an individual analysis at the company or nonprofit level. Does this make sense? And it's not just dollars and cents. It's also, to your point, Michelle, mental health, peace of mind, productivity, frankly, an added pay bump, and maybe a way to retain people.
Yeah. I would say the biggest use cases of our platform is the retention and the recruiting, where you really want to be able to be competitive in terms of the benefits that you offer, being able to say lower, that pay bump because you're lowering someone's debt is huge. So definitely, that's how we have a lot of groups really thinking about the use of student loan. And look, we were just at HR Tech. We had over 300 people at our booth come up and was like, I have an issue with student debt. I've been hearing about this. I want to offer it to my employees. We work with one vet corporate group that for every vet that leaves, it costs them $500,000 in lost revenue because it takes them forever to find someone to replace them. It is, kind of, there's not a lot of them that exist out there. And so a lot of them are looking, and same for cities and nonprofits. They're like, look, we're fighting private sector for, these employees. And this is a way for us to really help on that retention piece for nonprofits and public. Great.
So Michelle, the fee is 12. Oh, I'm sorry. Just wanted to clarify the $12 fee is for all three programs, or is this just for the summer save?
So that's just for save, but this is also where like, look, we'll get creative and we'll talk through all of that.
Okay.
So we don't have like we have like some standard pricing, but I always just hesitate just to throw a number out there because I think we can definitely get a little bit more creative with the situation and the way that you guys all come together and do something that will really work for everybody. But it's generally a per person, and it's that amount. It's like we typically quote like a $12 to $15 per person per year amount.
Can I ask a question?
Yes,
yeah,
please,
Cindy.
So I have three kids, one out of college, two in college. I have made them take out their lovely Stafford loans that they have. My understanding is the loan forgiveness, which my oldest daughter has done the income driven. It's only for federal loans, correct? Like if there was a private loan, student loan, Parent Plus loan, none of those are at all able to be forgiven.
The income driven is for federal loans only.
Okay.
Majority of loans out there are federal. For private loans, if there's an interest in consolidating or there's an interest in refinancing, which this environment's not great for, but
right.
But those are other options too that we help facilitate for the private loans.
So for instance, though, and I don't know if you can give me a good idea of this, my oldest daughter, so she's on an income driven, interest rate's still high. So now her payments are lower, but interest just keeps compiling. So how does she ever get ahead of that? Like I feel like those are the questions that's the problem, right? That's why we're in so much debt in this.
Yeah,
this society
that is a huge problem. More people graduate, or like 20 years later, people are paying off more money because of the interest rates.
Right.
And unfortunately, we don't have any control over those interest rates, but what we can do is just lower the principal of it. And so you're still lowering, at least you're lowering the amount of what that interest rate is on. And then the more so as an employer too, the contributing directly into someone's principal will help them lower it. So the combination of like, look,
right, that's great.
I don't know who your daughter works for, but like if they offer a student loan contribution program,
no,
she takes, but if they did, she should take advantage of that, right? Because that'll just whatever you can do to lower that principal. And it's applying for all these different income-driven repayment programs. There's a lot out there. There's also state income-driven repayment programs. We don't do the enrollment for the state ones. There's a lot of them, but we help. What we do is help recommend them, and then our student loan experts can get on the phone and help them direct even more. Which ones do?
Good to know. Thank you.
But just to be clear, though,
thanks.
Just to be clear, though, Michelle, those income-driven repayment programs don't lower the principal, right? Doesn't it just spread the payments over a longer period?
But you're paying them down over time. You have lower payments, and some do they do kind of elongate them a little bit, but they are just really reducing your monthly payment. And then for the public sector, that is that pure forgiveness in terms of wiping them away.
Uh, okay. I mean, isn't it like basic algebra? And maybe I need Paul's help here, because if you have you have a principal and you have an interest rate, the only way that you can lower the monthly payment is by spreading it over a longer period of time. So in effect, you're actually paying more in interest because of that longer repayment period, right? So you're
I'm
not
happy
really
to,
saving
yeah,
anything.
I'm happy to pull together some of the case studies that we have on how the total amounts of the income driven. And I don't have the specifics of those specifically, but those that I can provide kind of case studies for those and how it works. And we
Yeah,
probably
that'll
should
be
do a
helpful
demo
because
too.
Rose, you're right. That is how it works. But there may be some other negotiating that goes on, or there may be some other, it's a deferral and then a
Referral grant
forgiveness.
programs. There's many different ways that we recommend it. But also, kind of going through the steps and showing you the exact experience and like what these programs are. Happy to pull in some of our certified loan experts too to talk about very specific programs, if that would be helpful.
Great.
Oh, folks, we're coming to the top of the hour, and I'm sure some of you have yet another call to go to. So, Michelle, I do appreciate your time. I have reached out through LinkedIn. I realized we weren't connected, so my bad. Anyway, I've sent you the LinkedIn connection,
Thank you.
and I look forward to continuing this conversation. Next steps, the recording will go out with the case studies, and I'm just trying to see where people's interest lies in this topic. Is this something we should be pursuing, to Paul's correct phraseology, we should be negotiating with Meet Summer? And of course, I will run everything by my home office compliance. That way I don't get in trouble for anything. Yes, that's never a good thing in my industry. All righty, folks. Well, I appreciate your time. Everyone, have a wonderful Friday and an enjoyable weekend. Bye for now.
Thank you, everybody. So nice to meet you all.
Bye.
Bye.